welcome back. Dr. Hassan Mahmud, the Director of Monetary Policy Department at the Central Bank of Nigeria, is joining me right now virtually. Dr. Mahmud, good morning and thank you for joining us.
Good morning, Nancy. Nice to have me here.
Now, let's get started. We're looking at Nigeria's monetary policy framework, but I would want us to get started from the definition. Define what monetary policy framework is. I know last week we talked about monetary policy. You defined monetary policy, but define monetary policy framework for us.
Okay, thank you very much, Nancy. Good morning, everyone. The monetary policy framework is the institutional arrangements around how you want to deploy your monetary policy tool. That means it's the structure within which your monetary policy would play. And generally, there are different frameworks for monetary policy. Currently, Nigerian Central Bank of Nigeria adopts what we call monetary targeting monetary policy framework. You know, there could be inflation targeting monetary policy framework, there could be exchange rate targeting monetary policy framework, there could be a mix of both. And what the framework means is what are the pillars within which you will implement your monetary policy framework? What is the direction within which your monetary policy framework will take? And what will be the transmission mechanism, the channels through which those monetary policy tools will play through to impact the macro economy. So the framework is the structures within which you want to implement your monetary policy framework. Generally, the monetary policy framework is guided by the theoretical, background which we use to, appraise the economy and also connect the sectors of the economy. It generally comes from a very thorough understanding and analysis of the economy, how the economic characteristics interplay, the sectors, the real sector, the financial sector, the external sector, the monetary sector, how they interplay, and how efficiently you think you can move this monetary policy to achieve the ultimate goals for monetary policy. Monetary policy has its own objective. So it is just like the house within which you will play to, achieve your monetary policy goals. So the framework is a structure within which you want to, implement your monetary policy.
Okay, Dr. Mahmoud, I always say let's try as much as possible to make this program very basic. I try as much as possible to make my program as elementary as possible. I know that this is like for universities or PhD people or those studying economics and all of that. But I want us to put it in a way that even market women, people, even students can actually understand what we're talking about. So what kind of monetary policy framework does the CBN, do? If I got you right, there are different types of monetary policy framework. Is that what you said? That some people do
yes,
foreign
yes.
exchange rates as well as inflation targeting. What did you call the one that the CBN does?
Okay, right now, Central Bank of Nigeria adopts, or the monetary authority, that is Monetary Policy Committee of the Central Bank, adopts what we call monetary aggregate targeting. And what is monetary aggregate? Monetary aggregate is around the quantity or the volume or the number of money within the banking system. That is, and we call it money in circulation. And when I mean money in circulation, the idea here is that the volume of money, volume means the quantity of money in terms of deposit within commercial banks and merchant bank, the reserves of the banks, the CRR, the monies with the central bank, the deposit of commercial banks with the central bank, all those amounts of money within the system. It's what we call the monetary base. And that monetary base, the idea behind it is that the volume of that money within an economy at any particular time will impact on the prices within that economy. And these prices include prices of goods and services that translate into the changing in those prices, what we call inflation, the interest rate, that is the cost of credit, the cost of, and also the deposit, the opportunity cost of deposit, that is the interest you earn from depositing, and the cost at which the interest rate at which the bank lends to the generality of the public, including government, and also the exchange rate. Exchange rate is a price because that is the price between your currency and other currencies. So monetary targeting framework assumes that the volume of currency you have, money you have, which is now Naira in Nigeria, will determine how these prices behave. So if the volume of money within that, because there's a threshold at every level of economic growth and the stability you see within the system, macroeconomic objective, there's a volume of which you think is appropriate for growth to be, optimal and prices to be, at a stable level. If the volume of money within the economy is more than that, that means we say too much money chasing too few goods. And that would mean there's a lot of money, so everybody wants to have money to spend. What that does is that the interest rate goes down because nobody wants to take money from you, so everybody wants to spend money. But it also means that aggregate demand is the total number of demand, the things that people buy, services, goods, everybody, government, institutions, corporate, that demand is what they want to buy. People want to buy rice, people want to pay for electricity, people want to buy cars, people want to fly on plane. That is what we compute as aggregate demand. When this volume of money in circulation is too much, everybody needs it. So you see that the demand for these goods and services is so high. So the prices of those goods and services will start going up because people that are supplying have so much demand, and you start seeing the price going up. If you go to the market where they are selling goods and everybody's going to a particular shop and the shop stock is finishing and it's in so many, you want to maximize. So you will now be hiking the price. And because people know that you will soon finish, everybody will start buying. So that is too much demand, chasing too few. So you see prices going up, and that's why you start seeing inflation and stuff. So the idea behind monetary targeting is that if you control this volume of money within the circulation, or within the economy. And I'm saying, if I'm saying economy, I'm talking of the structure within which the monetary policy plays out, which is the framework that you just asked me in the first place. Within that structure, which is the banking and financial system, the formal sector, if the volume of that quantity of money is above the threshold at which the economy, which is optimal for the economy, you see it impacting on price. So the idea for the monetary or central bank is that control that level of money within the economy, which is the liquidity. If you control it, then you'll be able to moderate the behavior of this prices. That is the essence of adopting a monetary aggregate monetary policy framework. So you look at the aggregate. What are the aggregates? This reserve money I'm talking about. The liquidity within the system. Those are the factors that you'll be looking at. Money supply in Nigeria now. Money supply. We have I don't know whether to. We have M1, M2, M3. M3 now includes other, OMO and other instruments that we have, but that is a bit on the high side. But it just tells you the amount of money that goes into the economy through these channels. The ones that go in from savings or current account, the ones that go in the bank's books as long-term savings. So those are the components we calculate as M1, M2, M3, and then you get a total number of liquidity within the system. So it's that liquidity that you control. In most cases, maybe as we go on, we'll be explaining how you control those level of liquidity, because there are instruments you use to increase the liquidity or to reduce the liquidity. But that structure of addressing liquidity within the system to impact on domestic prices, don't forget that this activity will only impact most significantly on your domestic prices, which is the interest rate, the inflation, the exchange rate, to some extent asset prices, because asset prices means the prices for your share and stocks that you do in the capital market, because they're also a function of how the economy is performing. Because the share prices are shares that you have in companies, and those companies are producing things and creating jobs. So if economic situation is not too good and they're not able to produce, then you see the share prices going up. So since monetary policy will impact on these activities, then you see it also extending to that, including what we're doing. Fixed income. Fixed income is where you buy these government bonds and other instruments that are issued by corporates. So there's a price there. So the interest rate, fixed income rates is also a price there. Then you have the short end of the market, which is what we call short-term end of the market, where you have instruments which the central bank now use to interplay with commercial banks, which are the people that the central bank really relate with. So the rate at which the central bank lends to these people is also influenced by this monetary aggregate framework, because central bank is seeing how much is within the system and how the banks are trading among themselves. Even if central bank trades with the banks also trade, do transaction among themselves. They do placement and taking. So you have the interbank markets where they also sell, they give money to themselves, overnight, it's okay. I'm short of this before 4 o'clock this evening. I want 100 billion. Union Bank will give Zenith Bank, like that. They do trade, and that trade has a price for giving those monies. So all this interplay to within the framework of monetary aggregate targeting framework. So what they target, what we call operational target and the ultimate target. Ultimate targets are tied to the objective of the monetary policy. I think we will come to that, Nancy. But the operational targets are this instrument that I'm talking, the open buyback. I explained it the last time we discussed on monetary policy. The monetary policy rate itself, that is the rate at which central bank lends to this commercial bank, the spread of that rate, we have the upper and the lower band. And so the concept is that these rates, like the OBB rate or the overnight call rate, are supposed to play within this band. I think we'll also explain that as we go into the space. It's going to be a bit difficult not to be a bit technical, because these are things that we do within a complex analysis environment, and a lot of forecast and a lot of interplay within the banking system. But I'll try as much as possible to make it understandable. But the point is that within this liquidity management framework is how you deploy monetary policy tools to address your targets. Maybe we'll talk on what are even the objectives of monetary policy, so that we can get into how these tools work, Nancy.
Okay. Doctor, you've spoken for like 5 minutes or more than that, and I allowed you, I'm speaking with a doctor this morning. I know I'm understanding what you're saying, but I'm also pushed to break it down for them. While you were talking, I was seeing a lot of technical terms, hearing a lot of technical terms, and I'm being forced for us to break it down. Now, I asked you earlier what kind of monetary policy framework, and you did mention monetary aggregate targeting. That's what the CBN practices now. You have inflation targeting and all of that. We'll come to that. But I also want to say, at least for our viewers, for those watching us right now, to understand why this topic is essential. We're talking about the monetary policy framework because it empowers monetary policy making. It's a useful vehicle to steer or to foster policy making, and it has its own foundational or even fundamental role in the economy. So for the MPC meetings that you see 6 times a year, Dr. Mahmud is trying to explain how it is done and all of that. There will be a meeting, I think, in the next 1 month or so of the MPC. So this is like a prelude to that. So Dr. Mahmud, you also did mention, I'm being forced for us to go back. You mentioned, okay, M1, you mentioned M3. M3, for people watching, can we break it down? Or perhaps I should do that, then I'll come to your question. Perhaps let me do that. M3, just like Dr. Mahmoud mentioned, okay, I can't go to M3 without talking about M1, M2, because there's M1 and M2. M1, for those watching right now, constitutes like the physical cash in your hand, the currency, that is the Naira, and there's no kobo again. CBN, no kobo, I've not seen kobo. So the Naira's in your hand, the physical cash in your hand, that's what M1 is, the liquid deposits, that's what M1 is. The M2 really includes both those cash, that's the physical cash that you have, and easily convertible cash, so to speak. Then M3, M2 also constitutes M1. Doctor, I hope you are listening. In case I'm wrong, you correct. M2, yes. M2 constitutes M1, right, yes. Then M3 is equals to both M1 and M2. As a science student, that's just how I can explain it, And yes, so doctor, is that right? At least for my viewers to understand.
You're very right. Yes, you're very right. M1 is the current account, like you explained. M2 is the M1 plus quasi money. Quasi money is
Money, yeah.
something that looks like money. It's liquid, but it's not cash. But you can convert it to money easily.
Yeah.
That is the M2, which is the term deposit, savings, and those are the M2. M3 is now moving into other instruments that are held by the bank from the central bank, which include OMO bills and all that. So the way you explain it is very correct. That is the M1, M2, and M3. And M3 is coming into the space now because we have a lot of that also within the system, and it plays a role in determining the rates that operate in the money market.
Okay.
You are very correct.
Okay. So, doctor, don't, just allow me, because we're in a class. This show today is like a class. So you did talk about, I want to go back to inflation targets. And is it that the CBN does not do inflation targeting? Because the inflation target for the CBN is 6 to 9%. And it not just starts with this administration. I think even when the former emir of, the 14th emir of Kano, Sanusi Lamido Sanusi, was the governor of the central bank, the CBN had a target of inflation digit at 6 to 8%. So where does that fit in? I hope you understand what I'm talking about. Yeah.
Okay. Thank you very much for bringing this up. The inflation targeting framework is a bit different in the sense that what that means is that just like monetary targeting framework, we are targeting the monetary base, and these are the money supply instruments that you just mentioned. The inflation targeting framework is that you are targeting inflation. So ab initio, ab initio means from the beginning, you already have a particular inflation number that you want to achieve. And everything you do, monetary policy, fiscal, is to meet that inflation number. If you don't meet that inflation number, you are assumed to have failed in terms of achieving your mandate. So everything you do is to get that number. So the central bank that is doing inflation targeting will have done all their calculation, all their forecast and everything, all the mathematics behind the door, and said, okay, our inflation target is 9%. So if it's currently on 13, all your efforts will be to bring it back to 9. If it is currently on 2 or 3, all your efforts is be to raise it to that level that you think is optimal. That is the changes in prices that is optimal for the level of growth and stability in your system that you want to achieve. For you to adopt inflation targeting framework, number one, central bank must have the authority to have a control over adjustment towards achieving this inflation number, which means that the central bank independence in terms of policy independence is very strong. Number two, it also entails that central bank credibility. Credibility means that, just like the normal world of credibility, the integrity of the bank or the ability of the bank to keep to its promises is very strong. Nobody can influence that. So if you say you're going this way, everybody, that is the players in the economy, the consumers, the investors, the banks, are sure that yes, that is what you are going to do. You are not going to change along the line, say, oh no, because the president said this or because the National Assembly said this, I changed this. No, you will have a strong credibility to be able to achieve that. And also you'll be the one that will choose the inflation numbers that you want to achieve. Now, that is inflation targeting. Some countries are already adopting that for so many years, even within West Africa, and most advanced economies are also doing that inflation target. So their target is inflation. Everything they are looking at is inflation. Currently, our own central bank, our target is the monetary aggregate. But within that monetary aggregate targeting, we are looking at inflation. We are looking at exchange rate. We are looking at interest rate within that framework. And what it means, so the 6 to 9% you mentioned is the rate of inflation that we think scientifically now, empirically now, is conducive for sustainable growth. Sustainable growth means that the growth that will not collapse very easily by some certain shocks, or the oil price changes, or there's crisis in the financial market. So you have that sustainable, or what you call inclusive growth, where everybody's taking part in that process means that they are being employed, they are producing goods and services, they are also earning income. So if you have a particular growth target and you said, okay, this is the inflation number, because if inflation is too high, it also brings down growth, because people will not be able to buy things because prices are too high. If they are not able to buy them, the sellers will have them in their shops until they expire. So they cannot sell them, so they don't even have money to pay their workers. And so the next chain of action is that they will not produce, or they will not even be able to produce. So you see, if GDP, which is gross domestic product, is measured by economic activity in terms of production, then you see that production number going down. And if it's going down, you see that GDP, the growth rate of that going down. So inflation has impact on GDP. So if you think that this is the optimal GDP number you are trying to achieve, the GDP growth rate, then this is the appropriate inflation. You target that inflation to achieve this other goal. So your primary target is that inflation number. What we do now is like going through another channel to hit this same inflation and other prices using that monetary aggregate. The 6 to 9% single-digit inflation number, we also see that as conducive for growth. But what we say now is that the central bank is more or less doing what we call not explicit, in the sense that we are not announcing that this is the inflation number that we want in this economy, but implicit, that we're looking, implicit means inside us, we're looking at this inflation and we think this single-digit inflation number is most conducive for sustainable economic growth or positive economic growth. What that also means is that the fiscal and the monetary authorities must, we do what we call this medium-term expenditure plan. Within that medium-term expenditure plan, government tells you what they want to do, how they want to achieve that. We, from our side of the central bank, we have already projected how much will come in from FAC, from other inflows, from loans. So don't forget that we're using monetary aggregate. So we already know the injections that will come into the economy for January, for February, for March, for April. We know the optimal for January, February, March, April. So if, for example, what comes in is more than what is required for March, central bank will pull all those funds out. Within the monetary aggregate framework, pull all those funds out and hold it. It's not within the system, so it's not affecting price. So you now start seeing the price is not changing substantially. But you also have a target, or single digit, which is, like I said, coming in from the fiscal region. But nobody will hold central bank explicitly responsible for that inflation trajectory in terms of accountability. You are playing a role to bring down domestic prices, but the target that you have given is not the one that is in question in terms of you have not come to announce. Where you do inflation targeting, you will announce that central bank monetary authority will announce that this is the inflation number. If you go to the US and other advanced economies, they have an inflation number. They even have what you call the national inflation level, the natural rate. And that means that at full employment means maybe like 2 to 3% of unemployment within the economy. That is almost every activity is actively involved in the economic activities. At full employment, this is the inflation number that we want. So you work towards that full employment, GDP growth, and then the low prices, that the inflation number that we achieve that. So that is what we refer to as inflation targeting inflation.
Okay, let's talk about the tools now. Can you just run us through the tools and the objectives?
The objectives of monetary policy?
Yes, the objectives and the tools within the monetary policy framework that the CBN uses, at least those of you in the MPC,
Yes, within all the analysis and talks that I've made, I've mentioned essentially all the monetary policy objectives. But in specific terms, the principal or primary objective of monetary policy within the Nigerian context now is low and stable prices. And that will by extension mean that you're also targeting GDP growth, you're also targeting unemployment, you're also looking at stability in the financial system. So you're looking at the level of credit expansion, how the banks are also playing within that space, because the interest rates that you are trying to achieve using your monetary policy tools is the one that you think will enable, the people have access to credit, particularly in critical sectors that you are looking at, such that they'll be able to do their production, improve on their productive activities, which is now productivity, and then be able to impact on the economy positively, creating jobs, particularly the SMEs and all that level. So the objective primarily of monetary policy is to, look at these buckets of outcomes, which is the ultimate goals, which is the GDP growth, positive GDP growth, and by extension, the GDP should be growing faster than your population growth, so that your per capita income is when you distribute the entire GDP income of the country to the number of population of the country, even though it's a what you call straight line distribution, but it gives you an idea of what each person, will be entitled to in the list. We discount what we call the inequality index in this one, but it gives you a general idea of what is the per capita income per each person in an economy, and that is when the GDP growth or the total income of the economy is a lot, higher than the speed at which the population grows. So you want to achieve a GDP that will be improving on that, because GDP is not important if it is not, reducing poverty, creating employment, making income that people earn a lot higher, and they're also discounting it with inflation, making the real disposable income a lot higher. So generally, those are the objective for monetary policy, stable and low inflation rates to achieve sustainable and inclusive growth. The tools that you use within that space is also some of the things I've already mentioned. One, for achieving our monetary policy objectives through this channel, this financial system, banking system that I've just mentioned, is to use one basic tool, a principal tool, is the monetary policy rate, which is the rate at which the central bank lends to the rest of the commercial banks, and by extension, those banks now build, because this rate at which central bank lends to the commercial bank, we call it risk-free. That rate does not have any risk. If you loan money to central bank, you cannot lose that money. So that money does not have any risk. So we call it risk-free rate. However, if central bank loans to Mahmoud or Nancy, there's a risk, because we are individuals, we have issues, our businesses can fail, our salary can be delayed, so we cannot pay. So the bank will calculate that risk, the likelihood of you not paying, and then we'll build it into the cost of giving you that much, so that the bank will continue to be existing, even if you are not able to pay your debt. So, and that is that. So that premium, that cost, will build into the interest. So that's why you see, even though the central bank monetary policy is 14%, the lending rate is 20, 22%. They are building those premium, and it varies. The rate at which they will lend to me, Hassan Mahmud or Nancy, it will be different from the way they will lend to Dangote or Tedola or MTN, or, so they have risk profile that they look at. And your risk profile also depends on the collateral you have. If you are borrowing 1 million, you have a collateral of 1 billion, your rate will be very low, because they know that they can sell that 1 billion even at half price, and they'll still make
their money back.
Their money. So that monetary policy rate is that anchor rate that we use to impact on other rates. The OMO that I explained, open market operation, which is the process at which we, mop up, we call it mop up liquidity. I mentioned the monetary aggregate framework, where you look at the quantity of money. When the quantity of money is so much within the economy, what do you do? What you do is that you use that open market operation as an instrument. It's like a certificate. You sell it, it's a paper. You sell it to the banks. When you sell it to the banks, it means that you give the bank that paper, that certificate, and you collect the money of the value of that certificate. If the OMO bill is 100 billion, you give that bank 100 billion certificate, like a check. He holds 100 billion in his vault, and you collect the 100 billion cash from the bank and come and keep it in the central bank. The money in central bank is not for spending, so it's like you are taking it out of circulation, the central bank reserve. So that OMO bill is what you use to mop up that liquidity. In the event that the liquidity is also going down, so rates are going up because banks don't have money at the interbank market, you will now say, okay, bank, bring that your certificate I gave you the last
And
time.
I give you back the 100 billion.
Okay, take 50 billion. So the bank sells that certificate back to you, and you give the bank 50 billion naira cash. So the bank has 50 billion naira cash in its vault. So you start spending, and then you start seeing money within the system.
Okay.
Another instrument that we use, or tools that we use in that place, is cash reserve requirement. You know, ordinarily, because everybody goes to the bank to deposit their money, and they come at different times to come and withdraw this money. So central bank ensures that the bank always has money to pay these people that come to look for their money at any time. The bank, if you are going to the bank tomorrow to collect 100,000, you don't call them today that, First Bank, I'm coming tomorrow, I want to collect 100,000. No, but the banks also do their own calculation and say that, okay, given this volume of customers and this deposit, current account and stuff, you know, some money they don't collect every day. Some you give notice. This amount, averagely, maybe we'll be spending withdrawals 100 billion. But in the event that the withdrawal moves to 200 billion in a day, the banks will also not panic. They will have where to fall back to and say, okay, please give us this money before 2 o'clock today. We have more volume. So there's what we call cash reserve requirement, which will be the cash that the banks will have with the central bank. You know, so at any time they can meet that. So there's a threshold that we give. We don't announce our monetary policy communicate. We'll tell you about 3 buckets: MPR, exchange, CRR, liquidity ratio. Those are the tools for monetary policy. So the cash reserve requirement is what we hold. So anytime we see that the banks are having too much money with them and they are not lending out, we pull part of them as cash reserve and keep it with us so that it doesn't affect the prices we have within the system. We also have what we call the liquidity ratio. This liquidity ratio, that's that one which is almost our 30% now of most banks are doing above 40%, is the volume of liquidity that the bank are supposed to have even within themselves to be able to. Central bank calculates that, you know, more or less on daily basis to see that the banks have enough liquidity to meet their liquidity. Means cash, immediate cash, not something that you have to wait for 4 or 5 days. No, cash immediately. That's the liquidity they're supposed to have for them to be able to, you know, meet the requirement of the central bank. Other instruments include, you know, the treasury, which is where central bank also use the CBN bills that you use to for OMO, and the treasury bill is the ones that you use to borrow money for government, and also people invest in those instruments. So those are generally the tools, the tools through which central bank achieves its ultimate goals or impact on its operational targets.
Okay, Dr. Mahmud, thank you for that explicit explanation. You know, and you're not giving me a chance again to ask another question because we've come to the end of the show. I wanted to ask the evolution of monetary policy and unconventional tools, but that will be for another day. Now, it can't be for today because you've really, you know, widely looked at the tools by which the central bank achieves, you know, price stability and what have you. So I want to say many thanks for joining us. We'll continue this discussion on another day, God willing. So thank you very much for joining us today.
Thank you very much for having me. Have a nice day.
All right, I've been speaking with Dr. Hassan Mahmud, who is the Director of Monetary Policy Department of the Central Bank of Nigeria. We've been looking at understanding the monetary policy framework of the Central Bank of Nigeria. I hope you learned a lot from today's show. Today's show was just like the lecture. Lecture what? 101, money line, MLWN. I can see my colleague at the back of the camera doing like this. If he it sounded like that, isn't it? All right, the news is up next, and if you will be here to take us through AIT reports, I am Nancy Naji. Be the best you can be and be that change that you want to see. Bye now.